Good morning, everyone. Welcome to the penultimate day of our month-long ISA season presentations. Today, I'm really pleased we have Ollie Beckett, manager of the European Smaller Companies Trust. I think many of you will know that the UK is a fertile hunting ground for smaller companies, fund managers, and investment trusts are very well equipped to invest in smaller companies. Europe, our geographical neighbour, presents a similar opportunity in the sense that companies are less well researched, there's a lot of them, and they have the opportunity to perform very differently to their home country's economies. But as you'll learn from Ollie's presentation, Europe presents many different opportunities to the UK. It has a rich variety of industrial and technology companies, for example, that differentiates it from the UK. And so Ollie will run you through some of the key points of the trust over the next 20 or so minutes. And then there'll be an opportunity for Q&A after that. And for those of you who haven't joined one of these before, you'll see a little box in the bottom right-hand corner of your screen that says Q&A. Click on that. I'll be reading those questions whilst Ollie's talking. Don't be shy, put your questions in, and I'll do my best to answer to get Ollie to answer as many of those as possible at the end. If you have any technical issues during the presentation, then first of all, it is being recorded and the slides will be available to download, so don't worry too much. But if you're having problems, you can also drop a message into the Q&A box and one of my colleagues will have a look at that and try to help you if they can. And with that, I'll hand over to Ollie.
Hello, hi, good afternoon. As Alan said, I'm Ollie Beckett and I'm the lead manager on the European Smaller Companies Trust. So I'm going to give a bit of an introduction on the trust, say who we are, why this might be an interesting opportunity, certainly for the medium term. Clearly there's events going on in the world that make everything a little bit difficult in equity markets. I definitely don't have all the answers, but I do think this is an interesting opportunity within European smaller companies. So what does the trust do? We're investing in small cap, but Europe, and then excluding the UK. There are actually a couple of UK names, but predominantly we are excluding the United Kingdom. This is, as Alan suggested, it's a very wide universe of stocks, about 2,000 odd names. So even when the backdrop's as bad as it is today, there are interesting companies going on, doing their thing and growing significantly. Within the portfolio, we have podcast marketplace companies like Acast in Sweden, which are growing significantly, particularly in the US. We have companies like Elmos, who do semiconductors and sensors for cars. And even though the automotive market isn't that strong in Europe, it's still growing globally. And if you go in any modern car, you'll know there are more and more sensors. That's before we start looking at Waymo, sort of driverless taxis. So this is a very diverse opportunity. Vis-a-vis the UK, it is far more diverse, just because if you look at the European economies, look at Germany, look at France, the UK is very service-led. So this gives you a much broader exposure. Again, we do run quite a large portfolio in terms of number of stocks, up to sort of 120 names. So this is not your high conviction focus fund, which I don't really believe works year in, year out within the European smaller company space. Okay, so it's a very diverse portfolio, and it is true small cap, but that can be anything up to sort of 11 billion euros, but predominantly on average, we're sort of 1.5 billion euros. This trust is it recently merged with European Assets Trust, and post that merger, it will be paying a 5% dividend yield on an annual basis. It will be 5%, but that dividend will be paid quarterly. So that's a new thing about this trust and worth knowing, I think. There's 4 of us dedicated to this trust. There's three of whom you see in front of you. I know Rory and myself are all very pleased with life. I wouldn't say it's quite so much fun at this current moment with the current market, but the 3 of us are dedicated to European smaller companies, as I say, and then there's also a recent joinee, Benjamin Larvin, who's joined the team. We do, as I say, it's small cap, it's looking beyond large cap, and I think that's important. And actually, small cap at the moment, I think is a great opportunity. We're nearly at a 20-year discount to the larger companies. So on valuation basis, this is a great opportunity. But let's be honest with you, European smaller companies is geared to global growth, and that recovery in global growth will have been pushed to the right by the current war in Iran. All of us on the team, we're sort of fund managers, stroke analysts. So we spend a lot of time seeing companies, doing calls and meetings. And the whole idea of these meetings is to try and find inflection points, points of change. We're trying to find things that are getting better. And we spend a lot of time ourselves organizing our own meetings. So one thing I do promise you with this portfolio, it will probably be a different list of names to what you're used to. And as this slide alludes to, we care about valuation. Okay, in the simplest form, we're trying to buy undervalued companies where we believe the perception of the market is wrong. That said, valuation is never enough. We're not running a value fund. There must be a catalyst. That catalyst may be top down. It may be, okay, this is a defense stock, which we think is an attractive theme. I will point out that we will never buy a company purely on a thematic basis. The valuation must make sense. Or the catalyst may be internal. It may be, one of our largest holdings at the moment is a Dutch company called TKH. We're expecting to see a demerger of the business. It's split into an automation business and a cable business. So that always there must be a catalyst, okay? But we will remain valuation disciplined throughout. So the European Smaller Companies Trust, as you may know, is run by our team here at Janus Henderson. Janus Henderson is a large fund manager. It's obviously predominantly Denver and London based. I think the key here is we have all the support we need. We have a risk team. I've mentioned that there's 4 of us doing European smaller companies, but outside that, we have many other teams. We have a large cap European team who again will come down into our space, into the mid cap as they try and find growth, because as a reminder, this is where the growth is, not really in European large cap, bar the odd name. And we also will have sector specialist teams in things like real estate, technology. So there's a number of other people within this building we can feed off. We have a specialist ESG team, which is very important, particularly around engagement and trying to get that change within companies, whether that be on governance or on environmental issues. So look, the bottom line with Janus Henderson and the team being based here to run this European Smaller Companies Trust is there are no excuses, okay? We have everything in place to try and deliver the good performance for our shareholders. Looking at Europe's smaller companies and vis-a-vis large cap, look, over time, the European smaller companies has been a very attractive place to invest and has delivered far superior returns to their larger cap counterparts. Now, that hasn't been the case in the last 4 to 5 years. There's a number of reasons for that. We had the Russian invasion of Ukraine, which, like now, led to higher energy prices. And sure, the larger oil companies, etc., are larger companies. We then had that inflationary period and interest rates going up. And again, that tended to benefit financials, which are more large cap. Because the truth is, European smaller companies, if you look at the makeup, are more cyclical. There are more industrial companies, there are more consumer discretionary companies. So I don't want to be sort of disingenuous. For European smaller companies to really outperform, despite their superior growth, we need an improving economic environment. And I repeat, that clearly has been pushed further to the right with the war going on in Iran. Now, things can change very quickly, and history would suggest that these sort of big geopolitical events do create an opportunity for medium-term investors. And I would suggest that maybe Donald Trump doesn't really want to get engulfed in a war for a long period of time. So that could create an opportunity, and things can change very quickly. Oil prices can fall, where everybody now expects interest rate rises. Maybe at the back end of the year, that actually could be interest rate cuts. It's difficult to tell. But as I say, over the longer term, European smaller companies has been a very lucrative place to invest. Because unlike the US, as I say, if you look at European large cap, there isn't that much growth. I don't think we'll now get the high teens earnings growth we were forecasting at the start of the year in European smaller companies, but it will be far superior to their larger counterparts. In terms of what we look at for companies, a lot of this is what a lot of people would look at. We're looking for companies with high quality in terms of returns and in terms of cash generation. I would say the one thing that's slightly different with ourselves is we're looking for companies with improving returns in particular, because we think that's how you can get the sort of the alpha, and that that's why we do all these in meetings and calls. As I say, we're looking for inflection points. The companies that are going to drive sales, drive margins, and therefore drive up their return on equity, which tends to be a measure of quality. So that's what we're looking for. I'll come on to it. We're also, unlike many, we're willing to look across the sort of life cycle of companies, early stage companies, more mature companies, but I'll come back to that. And as I say, not a value fund, but valuation aware. And that discipline in the past has held us in good stead. And so it's something we will continue to do in the future. Looking at, as I say, how we work and it's like process, we do, like a lot of our counterparts, we will see a lot of companies do a lot of calls. And that's obviously become far easier to do sort of Teams calls and Zoom calls. So it's something you can do. And the beauty of doing European smaller companies is the management will talk to us. It's quite easy to get these calls set up, particularly working at Janus Henderson, which is a very relatively large fund manager. So that's important to us. We obviously, like many others, we have all the external broker research, which we use, as well as our internal research. Slightly culturally, maybe we're slightly different to others. As I say, I'm not necessarily a massive believer in being high conviction fund managers. I think it's more a question of questioning ourselves, actually. Where are we wrong? Rather than saying, well, we're definitely right, because that can lead to, maybe not where you want to end up. So that's culturally different. And even between ourselves within the team, we're set up to sort of question each other. We don't have sector responsibilities. We don't have country responsibilities. We vary who meets management teams. So we can have that internal debate, which I think is very important. As I suggested, one difference between ourselves and maybe some of our peers, they tend to be, understandably, it's a smaller company space, focusing on quality growth. Okay. Now, the majority of our portfolio is also in that space. I mentioned here names like Alzchem, a German company, who is the only Western producer of pure creatine. Creatine is obviously, well, not obviously, but it is a growing market as people wish to build muscle mass. That has tended to be sort of young guys in their 20s trying to bulk up in the gym so they look good on the beach. But actually, increasingly, that's becoming, and rightly, a more middle-aged audience as well for creatine, as I say, as they're trying to maintain muscle mass. And another driver more recently has been GLP-1, people taking GLP-1, which actually can lead to a decline in muscle mass. So actually taking creatine becomes a very useful thing to do and a good thing to do. But Alzchem has also seen a more recent catalyst for the stock and brought it to more people's attention, because actually they are also a producer of something called nitroguanidine. Nitroguanidine is a propellant. That propellant was maybe to use things like airbags. In this day and age, guess what? It's for ammunition. So they've got two growth drivers, creatine and the nitroguanidine, and therefore moving into the defense industry. Now, this is now under the company life cycle, a quality growth company. It actually started out in early life cycle, but it's obviously continued to grow. So as I say, we will also go down the market cap and invest in early cycle companies. One mentioned here is Kuros Biosciences, which is enhancing the treatment of spinal injuries, because it actually, their solution helps create bone growth to help the spinal injury fuse and create greater stability. And that's being taken on by more and more spinal surgeons, particularly in the US. So we'll go down the market cap, which many won't, and that gives us that opportunity there. Then we'll also actually invest in companies which some people may perceive as boring or dull, mature companies like Powfinger, who do sort of truck-mounted cranes. This is because there are valuation, we can be opportunistic around sort of valuation. Sometimes people tend to overstate structural change and understate cyclical change. So this creates opportunities in this sort of mature space. And then one area that's been particularly lucrative for us is in the turnaround space, where most people don't tend to play. These are companies actually not delivering good returns, but where we believe there'll be an inflection point. And a more recent one for us is JCDecaux, that a number of you will be familiar with through sort of billboards and digital screens in sort of transport hubs. This was a company that actually wasn't really meeting its cost of capital, but then they've made a number of changes. They've got out of unprofitable contracts in China. They're now running the business for cash, for free cash flow and margins, rather than maybe for sort of global growth. And then they've also now had the benefit that a previous competitor in many of their markets, Clear Channel, has pulled out of a number of those markets and sold their assets to, let's say, more rational competitors. So this company, JCDecaux, which has been struggling for a number of years, is now starting to see an inflection. And that's what you saw in their recent results. So this turnaround space, as I say, has been very lucrative for us. And it's quite unusual for small cap fund managers to play here, but we will continue to do that. So we will, as I say, we will invest across the life cycle of companies. And therefore, if you like, take a much wider funnel than the majority of investors will do in the European smaller company space. As I say, and I've gone through these examples here, so I'm just repeating them really. And as I say, we find opportunities, across this life cycle. Maybe now looking on to where we're seeing opportunities today. From on the sort of sector space, obviously there's a big debate going on around AI, artificial intelligence, and we can invest in there's a number of smaller companies that are very well exposed to this growth, i.e., if you like, AI enablers. So whether that be in the semiconductor equipment space, companies like Extron or SÜSS Microtech, both out of Germany, who are both seeing good, strong orders and good growth. Extron is helping in sort of the shift from silicon to things like silicon carbide and gallium nitride. So we hold those AI enablers, if you like. And on the other side, actually, in February, you saw a number of stocks selling off dramatically because of the worry around AI and what it may do for a number of sectors. So with that, when we're looking at whether a company maybe benefits or they may be hurt by artificial intelligence, we're looking at a number of things. Do they have proprietary data? Does it have regulatory tie-in? Is the company embedded in sort of transactions? Or has it managed to build up a sort of network effect of users? Because all of these things will defend a company from, artificial intelligence and the risks it may bring. So on that, we've seen a number of companies which we believe have been unfairly sold off. So these sell-offs, which are slightly sort of shoot first, think later, they always create opportunities. And under that umbrella, I'd mention companies like Karnov, a Swedish company that they own proprietary legal data. It can't be scraped by anybody else. Or Modern Times Group, another Swedish company, where they make mobile games. Sure, with AI, it may be cheaper to produce games, but actually mobile games are very cheap anyway. But they've built up this massive network effect. They're also doing something that we're also looking for all these companies from these companies. They're buying back shares, they're net cash. We're seeing management buying. All of these are positive signals. So when we're looking at sector exposure, we've got quite a high weight in technology, and we're seeing opportunities there, particularly maybe on the tech hardware space. Maybe some of the softwares and IT service names potentially are more at risk from artificial intelligence. And I mentioned a couple of Swedish names. Actually, in the short term, we're seeing a big opportunity in Sweden. Sweden's got a great equity culture, but the Swedish small cap space has been under pressure recently. It's got quite a large, I'd say Sweden's got quite a big retail equity market. And because of the momentum, people have moved out of some of the small cap space. There's also been a technical factor happen in Sweden this year where there's been a reorganization of the big pension funds in Sweden, the big state pension funds. And this has seen one of them sell off their Swedish small cap. So we are seeing, as I say, for the first time for a number of years, maybe even 10 years, Swedish small cap look reasonably valued. There's always been some great companies, but our emphasis on valuation has generally meant we are underweight. That has changed significantly recently, and we think there's a great opportunity in Sweden. Another big area of debate has been Germany. A Merz-led government, or CDU-led government came in at the beginning of last year. People all got very excited, unrealistically so. Look, the budget was passed in November, but people seem to expect an improvement before then. We are now seeing that defense spending coming through. We are now seeing that infrastructure spending coming through, and that is filtering through. And the big beneficiaries of this spending will be in the German small cap space, not in the DAX. It will be in the MDAX, and below that, even in the SDAX. So we still remain comfortable with our overweight position in Germany. Germany has to digitalize, is almost positively backward when it comes to digitalization. As any of you have tried to sort of get a taxi outside of Frankfurt will know, if you try to use a card, you get a pretty sort of terse response. So we still think there's an opportunity. I mean, short term, higher energy prices do hurt the German economy. And you don't want to be, exposed to maybe commoditized chemicals or anything like that. So we need to be careful where we're exposed within Germany. But I would say, I think higher energy prices clearly are a negative, but they won't actually massively impact a number of our holdings within Germany. Okay. So we still think there's a big opportunity there. And then obviously in vogue at the moment is in defense. We still think there's a big opportunity within defense companies. The focus of that spend may change as we're seeing the type of warfare change, and sort of low cost solutions like drones coming in. But what's becoming really obvious is that Europe will have to continue this defense spending. It cannot rely on the US. And I would imagine that it's fairly likely post Trump's sort of little excursion, as he calls it, into the Middle East, post that, there will probably be a deal in the Ukraine. He doesn't really have the stomach. He doesn't want to back Ukraine, and he seems quite keen to do a deal with the energy producer that is Russia. So in that environment, Europe is going to have to continue its spending on defense. And we have a number of companies exposed to that, whether it's Exosens in France doing night vision goggles, whether it's Indra, the sort of leading Spanish defense company. Now, a number of these companies have the negative of a lot of government involvement, but there's still, there's an opportunity here. So that is clearly an area where we will continue to be invested. This is the performance over time. On the whole, reasonably okay vis-a-vis the index. Clearly, at the moment, it's a little tough in the European smaller company space. But over time, this trust has delivered healthy returns, and our aim is to continue the same process that we've always used. I say, focus on valuation, but looking at the opportunities and try and look in different places to the majority of investors. I say, organize our own meetings, organize our own calls. And I say, one thing I promise you is slightly different exposure to what you may get from other parts of the market. Okay. I'm probably willing to take questions. I think I was wondering whether I have to put up some disclaimer form, which I can't find. But anyway, I don't know. I was told I needed to put up some disclaimer piece, but I can't find it. I don't know where it is.
Past performance is no guide to future returns. There you go.
Oh, okay, there you go.
Yeah.
Well done, Alan. That's great. And anyway, thank you very much for listening, and I'm happy to take some questions.
Great. I'm going to start. I don't normally literally read questions out, but there's a kind of clarity to this that I like, and I think you have views on it. You did touch on it briefly, and the European Investment Trust or UK smaller companies investment trust, which is best?
Which is best? They're different. UK is quite a narrow economy. Generalizing, we don't make much. It's a very service-led economy. And once you start looking at UK smaller companies, a lot of it is housing related. And you have to believe that the housing market is going to improve. So we can get much broader exposure in European small cap. Okay, so I think that's what we bring to the table. I'm not really sitting here telling you that. I mean, I think both UK and European smaller companies both look cheap on a sort of versus history. So I wouldn't say that. I wouldn't even tell you that you'll see more M&A in Europe vis-a-vis the UK, just because culturally in Europe we've got much more family-run companies, and there's more of a reluctance to sell. Whereas, to be honest, UK will sell anything to anyone, quite frankly. And you've got much management, more sort of option-led, shall we say. So it's more really, what does Europe bring to the table? It brings you opportunities. I mentioned some of those companies like Acast, a podcast marketplace. These things don't exist in the UK. Companies doing sensors and semiconductors for cars. That manufacturing base that the likes of Germany brings, or that nuclear power industry that France brings, or actually Spain, those southern European economies are doing very well post the financial crisis. And Spain is even a success story. It's an immigration success story, but it's also a success story on energy, how it's become self-sufficient in recent years because of solar, because of renewables, So more diversified would be the short answer.
And I mean, I think everyone viewing this will have heard the observation that UK equities generally and smaller companies in particular have been trading at very low valuations. How does it compare in Europe? And I guess we need to just be mindful that different sectors trade at different values, don't we? So it's not that easy a comparison to make, but as a generalization, where do we stand at the moment?
It slightly varies, as I say. So France would be at a slight discount. Switzerland's definitely at a premium. Sweden's still at a slight premium, but as I'd say the growth opportunities in somewhere like Sweden are significantly better than the UK. If you look at Sweden, we're starting, I mean, actually in real terms, people are better off. And that's before the big, well, where are we? Beginning of April, they're going to have a VAT on food will be halved, and they're going to have to be able to put lower deposits down on their housing. So, if you were to ask me which economy in Europe will turn around the first, I'm going to tell you is probably Sweden. In fact, the reason people aren't spending more is probably just because of the geopolitical backdrop and then watching the news. And so, but broadly, valuations are similar on PE basis, etc. I mean, the other thing is, look, if you were to take Germany, their government is in a position to do something, and they are around sort of defense spending, infrastructure spending. They're not burdened by debt as the UK and France is. So there's a variety within Europe. Got, let's say, Southern Europe doing well, Spain, Portugal, Greece, all those people that suffered during the financial crisis. But if you ask me, PE multiple, UK is marginally below Europe as a whole, but there's massive variations within Europe.
And there is actually a question asking why underweight Italy. Is that I dare say that's a stock picking, picking rather than country selection. But
yeah, it's not some dislike of Italians, believe me. So no, look, I mean, I talked about the opportunity in Sweden. I talked about the opportunities in Germany, but this is a stock picking fund. It's very much bottom up. Okay, so, but it just so happens, as I say, that there are now opportunities within Sweden because valuations have come back. So those individual companies are more attractive. So I tend to generalize and talk in a sort of top-down manner, but actually this is very much bottom-up stock picking. And we're not finding that many individual stock ideas to excite us within Italy at this current second.
Okay. And I think looking through the questions, we do have some people who are coming to this trust relatively new. So I'm gonna do a couple of specifics on the structure. You touched on the dividend policy, and there's a question that's essentially saying that smaller companies are more volatile. So how can you be confident about your dividend policy? So do you just want to touch on how that dividend is paid?
Right. So as I say, we're going to pay a 5% dividend. At the moment, the underlying yield on the portfolio is 2.7, 2.8%. So we're clearly going to pay some of that dividend out of capital. Now, this is effectively the same as doing a share buyback, right? The other thing I would add, without going into sort of the numbers and technical details, we have we have large revenue reserves. So we will definitely be able to pay that 5% dividend for the foreseeable future. And when I mean the foreseeable future, it's not even up for debate for the next 10, 15 years, okay? Because of the revenue reserves we have within the trust. But we are paying out of capital. You are right that smaller companies can sometimes be a volatile area because of that geared into global growth. And when global growth is questioned, it can at times sell off more than large cap. Actually, that's not been that significant year to date, but it has done in the past. So I don't want to tell you, yeah, this is, sort of the most secure space, because that would be disingenuous. But in terms of being able to pay that 5% dividend, yeah, we will be able to do that for the foreseeable future.
Yeah, and worth mentioning, it's reset every year to the NAV at the start, isn't it? So if your NAV does very well, the dividend will do very well, and vice versa. It's not a progressive dividend.
No. And it will be paid quarterly.
Yeah. Another question that again is coming to this with fresh eyes. So just talk a bit about how currency can affect returns. I mean, there's a sort of practical thing that this isn't hedged, and then maybe just talk a bit about what your currency exposure is and what big changes in currency might mean for your portfolio and some decisions you make. But I think the fundamental question is how do changing currency change the NAV? So if you just want to talk through that.
I mean, look, the majority of the exposure is euros. Obviously, there's a little bit of Swiss franc, there's a little bit of Swedish krona, a little bit of Danish krona. But we are not hedged, as you said. So if the euro was to fall versus sterling, this is a sterling denominated fund, then that would impact us. It would impact you as a shareholder, as an investor. So you do need to be aware of that. You are effectively getting exposure to the euro. Okay, so it's more diversification. Then within the portfolio, the companies we're invested in are exposed to, obviously, probably more importantly, the sort of euro dollar or Swedish krona to the dollar. And some of maybe, say, for example, Swedish exporters were suffering at the start of the year because of the strength of the krona versus the dollar. Now that's largely reversed quite significantly recently on the back of Iran. So there's a number of things we have to think about operationally and where we want exposure. But the thing you need to know as a shareholder in this trust is we aren't hedged. You will be getting exposure. I think predominantly think about it as to the euro.
Yeah, and actually, while we were discussing dividends, there was another follow-up question, which is how does this, if at all, affect your stock picking? I think it's a fairly straightforward answer, isn't it?
Well, yeah. I mean, look, we have to think about currency all the time, as I say.
But in terms of the dividend policy, you're not
no
hunting income, are you?
Well, no, sorry. Actually, that's a good point. So with the change in dividend policy, there's not been any change in the investment process. Okay, because we can pay it out of capital, because we have those revenue reserves, we are still seeking capital growth predominantly. That's what we're doing. We have a number of companies that do pay a high dividend within the portfolio. Whether, I don't know, Dutch wealth manager Van Lanschot will probably pay us a high single-digit dividend yield, but that's not what we're seeking, and that the process has not changed with the introduction of that 5% dividend yield.
Okay, and then we'll come back to some investment thoughts at the end, but there are a few questions about Saba, and I don't want to spend too much time on activist investors.
Sure.
But this trust has already been through its encounter. But what's the current state of affairs?
So last year we went through it, as you suggest, and we did a 42% tender offer, which led to Saba leaving the shareholder register, so they are not on the shareholder register. At that point, they also agreed to a 3-year standstill agreement, meaning that they would not vote against the board of the European Assets Trust for the next 3 years. So we would be hopeful that they won't be agitating again anytime soon. And then post that, to sort of rebuild the net assets of this trust, there was a merger with European Assets Trust, instigated by the board of the European Assets Trust. So that's got us back more to a sort of assets of sort of 950 million. So that's got us back to scale. But yeah, there is no Saba conversation on this trust as we speak.
Okay, and then, as I promised, coming back to investment, obviously it's difficult to say what the last month really means. But one thing we do know is energy prices are probably going to stay high for a while now. And so what lessons can you take from the last time we had an energy price spike, and what's changed? You know, there seemed to be quite a bit of will at the time for Europe to change its energy mix, and how successful has that been, and what companies do you own that can profit from the situation?
I mean, things have changed. You know, as I say, I gave them one example, Spain. If we went back in time, they were an importer of energy and no longer really are. They're much more independent. That said, they use much more renewables, and you saw the impacts on their grid last year. So, you know, one area where there's still a massive need for investment is in the national grids of all these countries. And that's definitely an area where we have exposure and can get exposure. Swiss companies like RNS doing transformers for the grid, or Nexans, a French cable company. So that's one area we can invest and benefit, because there's going to be a need for grid investment, A, because of renewables, but also because of all the sort of AI and data center spend. In terms of, you know, I mean, we don't have, you know, the single market in energy within Europe. As I say, hopefully, maybe actually in this current situation, you know, I would say is, you know, don't hold your breath on EU reforms and taking on board sort of Draghi's reforms that he's proposed, the former Italian leader. But in a crisis, Europe actually tends to get stuff done. In fact, it only tends to get stuff done in a crisis. So we may see more integration within Europe generally, whether that's banking union, single, you know, financial markets, etc., telecoms, energy, you name it. So hopefully we'll see some progress there, but it's not something we're sort of relying on to invest in this space. We have companies that will benefit from the greatest capex required in energy, and I think, you know, post this war in Iran, you will see another push towards Europe trying to gain more energy independence. You know, and then we do have companies that benefit more broad from the sort of global demand for energy. You know, we have sort of quasi-monopoly almost in GTT, a French company that has licenses the technology for the membranes to carry liquefied natural gas on ships. And again, obviously in this environment, doing very nicely. Or companies like Viridian in France, who own all the sort of the seismic data of where oil is, and obviously there's going to probably be more oil exploration and more oil production and development on the back of this crisis. So we can gain exposure. Maybe we need to gain more exposure, because as you suggest, I think it's inevitable that there's going to be a pickup in capex towards energy, all sorts, whether that's renewable, or probably people being more willing to take on oil. We're already seeing a pickup in spending, people looking at nuclear power with the sort of smaller reactors. I mean, the UK is looking at it, a number of countries in the Eastern Europe are looking at it. And there's a number of ways within European smaller companies we can get exposure to these niches. We have some, and maybe we need to look for more. But there's definitely going to be an area of growth, as you say.
Mm-hmm. And to finish on a optimistic thought, with the resolution of, you know, all eyes are on the Persian Gulf at the moment, but obviously Ukraine is there to be resolved as well. And how well positioned are European companies to help with the reconstruction? I think we think primarily about defence, don't we? But the reconstruction opportunity could potentially be quite large, couldn't it?
I'm sure some US companies will be involved in that reconstruction of Ukraine. But beyond that, look, there's some, I think, obvious beneficiaries, and they're going to be German, East European construction companies like POR, out of Austria. All these companies are well placed to help with that reconstruction that is really going to be required in Western Ukraine. So that there are a number of companies, and as I say, we're exposed to a number of them, which will benefit from that. So yeah, that will be a positive. And I'd also point out that at the moment it all looks a bit gloomy in the world, but on the days where people think there will be a relatively quick resolution in Iran, when that's the thought process going through the stock markets, the European smaller company space does outperform, or has outperformed. So what I'm really saying is, I think if you're looking at any reasonable time horizon, valuations are really low. The space has been hit quite hard in the last month. And I'm not going to say when this Iran war ends, but as of when it does, this space is really well placed.
Yeah, I think that's a really good point to wrap up, and we are actually at time in any case, which is a record for me. So Ollie, thanks so much, as ever. Very informative, a lot to think about. Anyone who's asked a question where we haven't managed to cover it, please do get in touch and we can try to answer that. As ever, there's a wealth of information on Ollie's corporate website, and there's a wealth of information on the Kepler website too, specifically to this trust and to many others. Thanks everyone for attending. Ollie, thanks to you, and
Thank you very much.
hopefully we'll see some of you tomorrow for the last one.
Okay, thank you very much.